Hey everyone, and welcome to episode three of the Money Coach Show. I'm Tara. I am a mortgage professional. I've been in the industry for about 7 years, and Robert is my partner and colleague. He's also got about almost 20 years of mortgage experience. And we also have Damien, who is our financial guru. Damien, you want to tell them a little bit about your history?
Sure. About 6 years mortgage banking experience, BA undergrad in criminal justice, MBA concentration in finance, about 12 years as an analyst. So that's just a real quick, kind of high level view of my experience. Back to you, T.
Awesome. Thank you. Yeah.
He's,
So
he's the
those of you
brainiac.
what's that?
He's the brainiac.
He is the brainiac. He's our guru. And that's kind of what this show is about. Those of you who are new here, Robert and I are going to teach you guys tips about the mortgage industry, updates in the market, and as well as what you need to know when it comes to purchasing a home. And Damien is also going to be our added bonus of tips on how to manage your money, prep for retirement, and things like that. So every week we're coming at you with new advice, great information. So be sure to stay tuned and subscribe to our channel. So I'll get us started off by talking about what's going on in today's market. Today is September 6th, so we're still waiting to see what the Fed is going to do with the rates. There was an underestimation, you could say, where they thought we had 818,000 more jobs in the market than we actually do. So this actually positively affected the stock market, and we're expecting this to affect the mortgage industry as well. And September 18th is the day that the Fed will have a meeting, and we expect them to cut the rates by 25 basis points, which is a 0.25% of a point. It's possible they do 50 basis points, which is half a percentage point. But we can't be sure. We don't even know if rates are going to go down. They could still even go up. So something that everyone should pay attention to is rates are in a 5% range right now, which is huge. We've been waiting for this for 2 years. COVID period, if you got your loan in that time, or if you ever got a rate above a 5%, 5 is a really good long-term rate to have, and it can save you a lot of money. So it's a really good time to refinance 30-year fixed rate in the fives. And yes, maybe the rates are going to go down in 6 months, but you could save, let's say, 150 today or 170 in 6 months. Would you rather want to start saving today? And so that's why I encourage people, if you got above a 5, it is a good time to refinance and talk to your broker about that.
And Tara, just to even interject right now, as I'm just looking, the rates currently are the best they've been in over a year. So keep that in mind. In over a year, the rates are the best they have been. Sorry about that.
Yes, exactly. And in addition to that, we're seeing that there are record equity levels right now, and there's a lot of people not tapping into that. So if you were to tap into your equity, you're going to have a lower loan to value ratio, which means you can get a lower monthly payment. You can also lower your mortgage insurance. So again, it's really a good time to refinance and something to consider with talking to your mortgage broker about. Um, we're also just sitting here with our fingers crossed, waiting for September 18th. And, because of the job miscount and what's going on in the market, and I mean, to be honest, a lot of federal agents are saying, the majority of them are saying they're probably going to cut the rates by 0.25%. So that gives us some hope that it's going to continue to go down over the next 6 months. So yeah, and in addition to that, I just want to mention, just a couple of weeks ago, like a week and a half ago, Polygon Research announced that when you work with a mortgage broker, consumers save over $10,000 compared to when they work with retail lenders. And retail lenders are like your big banks, big financial institutions. So there's just the proof, guys, that it's better to work with a mortgage broker when you want to buy a home. Don't just go straight to the bank and take the first loan that they offer you. And if you're a veteran, by the way, they were saving over $13,000 last year. And if you were a minority, even more than that. So yeah, that's it for my market update. I'm going to go ahead and send it off to Robert so he can talk to you guys a little bit about credit repair.
Thank you, T. And first of all, that was a great update there. It's like on average, $10,000 in savings. That's free money there. So, and as she mentioned, talk to your local mortgage broker. That's us. We'll be more than happy to help you navigate that. And you know what? And as T pushed it off over to me right now, I just want to give you guys free education alert. And that's basically understanding what unsavory credit is and what credit to strive for. So everyone always has that misconception on where does credit start at. Well, it starts at 300, and that's the very, very bottom of the teal. You don't ever want to be at that marker. The highest point of excellent is 850. So they have different tiers in there. They're going to be like red, yellow, green, better green, then hey, that shiny gold. And what I like to call poor credit is anywhere from 300 to 580. Now, fair credit is going to be anywhere from 581 to 669. That's going to be fair credit. Good credit is going to be about 670 to 739. And then we have very good credit, which is going to be 740 to 799. And then you're going to have excellent credit. This is creme de la creme, where we all should try to strive for is that 800 marker. It's going to be from 800 to 850. So, you want to try to strive for that. And I'm going to give you some good tips on how to do that. And, honestly, I wouldn't
Hey,
hand you
Robert.
tips. Yeah.
Hey, Robert, I got a quick question. So now
Yeah.
that you explained the tiers of credit and poor credit all the way to really excellent credit, does that affect like all types of loans? Like, I can't just be just mortgage loans, right? This is where maybe we can talk about the difference for all of our audience out here, difference between secured and unsecured debt. Do you want to go ahead and enlighten them and give them that lesson for the day?
Excellent question. Because before I give you those tips, like Damien said, there's two different types of credit you have. There's unsecured credit and there's secured credit. The difference between the two, and they both have an impact on your credit score and what type of rate you get on that too, as well as APR, depending on what you're buying, what rate you're focusing on. But your credit will dictate that. And the difference between unsecured debt refers to things without collateral, much like a credit card. That's just a card of value that they said you can go and spend money on it. Then there's secured debt. That's going to be something of tangible, something you can grasp onto. A car, a boat, title to your home. That's a mortgage. That is collateral credit. So it equals secured credit. So great question, Damien. And was there anything else did that help?
No, man, I think you covered it. It was really good just to covering the difference between secured and unsecured debt. But go on, man. I think you need to go into some of those helpful tips.
But also with that, if you maintain hemorrhaging from those non-secured debt, those entail will actually help you with those secured credit debts, because those are usually larger and far more expensive. And we want to get a better rate on those things. We want to get a best rate on everything. So always make sure you read the fine print. I'm going to tell you that right now. So cats and kittens. But let's go into those helpful tips. Okay, and the 5 tips I'm going to give you, I kid you not, they're tips that I've used and tips I recommend to everybody that has ears to hear. So the first tip is going to obviously pay your bills on time. The importance of paying your bills on time, it's going to supersede everything else. It's like if you're going to take on that responsibility, own up to it and pay that bill when it said it's due. So that's gonna be the first and foremost tip, and that should be everyone that's on top of everyone's list. The second one is keeping your credit spending low, and what I mean by that is, say if you have $1,000 credit limit, now within that $1,000, spend only what you can afford to pay back the following pay period. If you get paid bi-weekly, every weekly, or even monthly, whatever you can pay back in that time period, then go ahead and use it that way, so you can keep your spending low and then pay it off as soon as you can. And then the reason for that is the creditors see, hey, you know what, you're a good steward of your finances. We'll give you some more. Go ahead and spend a little bit more. And yeah, that's going to get you encouraged to want to be able to spend a little bit more. But what's more encouraging is the fact that that credit score is going up. Your credit limit is going up. The other one is going to be monitor your credit score. So we have, monitoring your credit score. Definitely you want to make sure anytime you get your credit pulled, make sure you gather that information, get a copy of it and look at it. Go through, see what it looks like, see what's on there, because there's some important things on there that I know I was shocked the first time I saw it. Now, if you haven't been able to pull your credit within the past year because you didn't buy anything of that needed your credit score on it, You can always get a free credit report once a year. I'm going to have a link for that down below in the description. It's basically the annualcreditreport.com homepage. And that's going to give you some prompts what to do so you can actually go in there and get your free credit report. You should do it yearly to monitor your credit health because, hey, there's that credit check. You know, that's another form of health. We got to keep that healthy. You know, our spending habits healthy, monitoring our credit because, again, it's all going to fall into place when you go and make those big purchases, such as a home, that we want to make sure we can help you with. Now, the other part is diversifying your credit. So there's many different types of credit, much like Damien mentioned, there's secure credit, unsecured credit. We want to be able to do this because it shows that there's an impact on your credit score in multiple areas. You can manage your finances really well. Obviously, I mentioned, you know, keep your credit spending low, but hey, you're going to have a car payment. Make sure that payment is paid on time. You're going to have a credit card payment, possibly. Make sure that's paid on time. Now, if you don't have one with your bank account, something I like to point out is you can always go to them and ask them for a secured credit card. Now, that's pretty important for those that are new in the credit understanding world and basically, hey, I don't have a credit card. I buy everything cash. I was that young dumb guy at one point and I didn't understand, hey, let me try to open up a credit card. I would get high interest rates or even denial letters, you know, because, hey, I made the money. I just didn't have the credit line. What a secured credit debt is, and this is a way you can diversify yourself, is going to your bank that you go to and ask them for that. It's basically a prepaid debit card that says, here's your credit limit. And then over a certain amount of time, it will mature into a natural credit card. And to be honest, for myself and my credit spending habits, that's been the one that it's gone up so much since I first opened it up. It is ridiculous. Now, the last one I have, tip number 5, is maintaining your credit history. So what I mean by that is, as I just mentioned, diversify your credits so you have multiple ones. Don't go crazy with it. Don't just say, hey, I need, you know, I'm getting approved for everything. Because on every credit card, you have an annual payment, an annual fee. And those right there can be pricey if we're not paying attention to the details at the very bottom of that credit application. So we always want to make sure what the annual fee is, you know, the annual APR fee. That's basically what it's going to be. And it's going to tell you, hey, this is what it is. So now I didn't dive into this because, you know what, some people say it doesn't work very much, but I've seen things in my credit score that I would attribute to it. And that's a power payment. Um, I mentioned it to Damien a few times when he was helping me out with some understanding of my finances. And I was, and I don't mean to rah myself, but when I told him he said, wow, that's brilliant. And it's basically understanding, hey, I'm going to make, if I have $100 payment every month on my credit card, I'm going to pay that $100. Okay. I'm going to pay it off right when it's due. Okay. Then later on in the month, usually past the halfway point, okay, we have that annual fee that we always pay. I divide that into 12 and then I'll make the payment that way. Yeah, you have to be very rigorous and understanding with your schedule. But when I've done that, I've bypassed that shock of the annual fee. They just remove it from there. The credit card company thinks, wow, this guy made double payments and he paid more than what he actually owes us. We like him. And it's a trick that I've done to see differences in my credit score, you know, and again, there's no scientific fact to it, but it's just something I've seen and it was curious to me and I attribute it to that. So I apologize about my rant, but was there any questions that either of you guys had or anything that I missed? Because again, those 5 tips I think are pretty beneficial.
Yeah, Robert, no, I really want to reiterate what you just said because that was really awesome advice. It is to pay off your credit card on the first or whenever it's due every month, the exact amount you need to pay, whatever's due. And then a little later than halfway through the month, pay whatever that annual fee is, divide by 12 so that you're paying down so that you can build your credit score, right? Did I get that right?
Correct.
Yeah, so that is great. Great advice for our listeners. And I also had a question for you guys, whoever wants to talk about it. Like, how do credit scores actually impact us when we're buying a home, when we're saving for retirement? Like, for the people that don't really know why it's important to have a high credit score? Like, can you guys talk a little bit about that?
I'll go ahead and grab this one, Robert.
Cool. Thanks, Damien.
In a really, really short and sweet explanation, bad credit always results to higher interest rates. So when Robert was going through that scale, somebody who had in the poor range of a 500 credit score range, they are going to be paying probably some of the highest interest rates that are out there that are available, whether they go through their bank or a mortgage broker, like you guys always mention. But even if they go through a mortgage broker, if they have really terrible credit, they're going to be paying a lot more. Now, flip side to that, Tara, they have great credit, like Robert was saying, excellent credit in the range of the 750 all the way to the 850. Oh my goodness. No, they're going to be paying probably the lowest and some of the best interest rates. So quick and short, just to the point, poor credit, very high interest rates, very high payment, you will be paying more money. Great credit means very low interest rates, much lower payments, you will be able to save money.
And Damien, help us out with this. Now, credit score, what type of bearing does it have on 401ks or investments?
Zero. Absolutely zero impact. Credit scores, it's the one aspect of the three things that we're always going to be talking about, has zero impact on your 401k or on your IRAs. Good question, Robert.
Yeah, and we want to make sure that you are comfortable enough with inside of your credit score to possibly be able to say, hey, maybe that money that I'm not spending on my credit card, I can, put away in my 401k or put it away in an IRA, something like that. So there's always those type of assets to think about.
And just so everybody knows, whenever you do apply for a mortgage loan or really any loan, anytime you get your credit pulled, the credit agencies sell your data, and that is why you get hounded with phone calls. Anytime you've tried to buy a car or get a mortgage loan, your phone is like ringing off the hook after that. And I just want to make it clear that that is not your mortgage lender selling your data. That is the credit agency. And there's really no way for us to get around that. And Congress believes that this is a way to practice fair lending so that you have multiple offers and multiple options. But you should always be wary of these callers because some of them will claim to be the same business of the person that you're working with, or you never know. So you want to be careful with who you're working with and make sure that they're not scammy. Again, like make sure that your broker is actually shopping the rates for you and educating you. You can always go with your gut in this as well. Because I think you can tell too when someone genuinely cares about your financial outcome and when they're just treating you like a number. And also, there is one thing that you can do to avoid getting these credit agencies selling your data, getting all these calls from other lenders. It is the website. We'll put it in the show notes down below, optoutprescreen.com. And you'll go in there. You do have to put your social and your information like that. So just make sure that the browser either has a lock screen on it or it says HTTPS. It's a real website. You'll put your social and your info and you'll say you want to opt out of being called, but it does take up to 5 days of processing. So keep that in mind. If you want to do a mortgage application and you don't want to get called by other lenders, this is an option for you. If you do want to get called, just to weigh out all of your options, then by all means, don't opt out. But a lot of people, I've had clients get upset about this whenever they start to get calls. So we just want to let you guys know how you can potentially avoid that. And yeah, otherwise, thank you, Robert, for that education on how to repair our credit. That was awesome information. Do you guys have anything else you want to add before we close the show?
No, I thank you for a great market update, T. Robert, thank you for a really good, insightful, and quick to the point lesson on credit and 5 really helpful tips for everybody out there to go ahead and be putting down on their cheat sheet.
I just want to round it off with, hey, keep that credit score healthy. It's like a muscle. If you don't use it, you lose it. And we don't want to lose that muscle there because it helps us out more than you realize.
Awesome. Well, thanks, guys. And everybody, check out the links below and tune in next week. We'll have more great information coming for you every Friday. Thank you.
See ya.
See ya.
Bye.